All right. Good afternoon, everyone. Whether you're catching this live or on the replay, welcome. I'm going to be doing a follow up to a previous live that I did last week on the mortgage or bills concept and how we can actually take the dollars that we're already spending and just redirect those and not spend any extra and be able to fund an amazing banking system. So I'll get into that in a minute. We'll give a few more minutes for everybody to hop on. That's kind of a rough gist of what we'll be going over. All right, we'll go ahead and get started. Once again, I'm Daryl Ellis, and I've been in the financial services industry for 3 years now, and came from the tech industry actually, and did that for close to 16 years. And so this was kind of a big change for me, but I just fell in love with it. I fell in love with the financial concepts that I'm dealing with. I really enjoyed the safety and security it provided for clients, and even for myself, I became a user. And I've got 3 of these type of policies myself with my family, and we use them regularly. And so anyway, I'll get into kind of the details of this. But as I had mentioned in the previous live, if you had watched it or if you hadn't, I'll go over this really quickly. I'm going to share my screen real fast here, and that way you can kind of get an idea of what I'm talking about. 1 second. There we go. Make sure I get the right one. All right, so the basic concept that I talked about last week was this 5-step process for basically being able to recapture the dollars that you're spending on your current bills. And I used a mortgage as an example just because that was an easy round number. And if you think about it, what if you could save the same amount that you're putting towards your bills, right? Most of us would love that. Most of us are trying to save whatever's left over, right? And that's typically what you do. You save and invest whatever's left over, and you put it into your IRA, your Roth, your 401k, whatever it is, and then put some in your emergency fund, that type of thing. But what if you could save what you're already spending, the dollars you're already putting out each month? And that is a possibility using this financial tool that we'll talk about. And so this is kind of the 5-step process. I'll go over it briefly since this is more of a follow-up video. But if you want more in-depth information, you can go to the video that I did last week on this. So the first step is you got to fund your private banking policy. And so we're going to do that usually looking at your savings. If you've got an emergency fund, you've got some money set aside that you're building up for maybe a sinking fund for a purchase of a vehicle, a purchase of some other larger item. It even could be something where you just have some buffer in your checking account so that way you don't go to zero between the cash flow of each month, right? Whatever it is. And so we kind of build it up, and then we start the process of funneling money through your private banking system. And so in the example that we're talking about, if it's a mortgage, let's say you have a mortgage that's $2,000 a month, we're going to take and funnel that money through the private banking system, and then we're going to go ahead and pay the mortgage. And I'll explain how all that works and the mechanics of it. You're going to do that by taking what's called a policy loan from the private banking policy that we set up, which is a specially designed whole life policy, which we talked about in the previous video. And I'll go into more detail on that and what that looks like. So you take a policy loan from that, and so the money continues to grow in the policy while you use the money that you're borrowing from the policy to pay your bills. And you're going to pay a little bit of interest, of course, to the insurance company for this, but the amount of growth that you're going to get on that money outweighs the actual interest that you're paying. So you get this great positive arbitrage in most cases. And so you're going to go ahead and pay your expenses, and then you're going to pay back that policy loan with the cash flow that you would normally use for those expenses. And so that's the basic process. And if I pull this up, you can actually see kind of the math of it. But basically, let's say you had $2,000 a month as your mortgage, and so that's $6,000 per quarter, right? And you're going to take that and funnel that through the system. And so you have $6,000 going in to fund the policy for a quarter's worth of mortgage payments, right? And then you're going to immediately take a policy loan for $6,000. So what's your net injection at that point? $0, right? And then you're going to go ahead and take from the cash flow of your monthly revenue or income from your paycheck or whatever it is, and you're going to pay back your policy loan and exactly the amount that you would have sent to the mortgage company anyway, right? So what's our total cost? $6,000 over 3 months, right? The same thing. We could do this monthly or we could do it quarterly. It's a little easier if you do it quarterly. But you can still do it monthly if that would be easier for you. Now, you've spent the same exact amount of dollars, right? But the benefit of being able to funnel that money through your system first, which is now going to grow for the rest of your life uninterrupted. Daily guaranteed growth plus the potential for dividends, which these companies that I work with, they've paid dividends every single year for, in many cases, 120 to 160 years straight, never missed one. So their financial reliability and their how solid they've been is consistent. Now, if you were to do this, right, it seems like, well, okay, you just kind of money in, money out, right? But if you were to do this over a 30-year period of time on a $2,000 a month mortgage, you could potentially save in that period of time $1.2 million, even though you didn't spend any more than you were already spending. I know it sounds too good to be true, and I get that all the time from people, but I've actually done it myself. It's not. It's just a way you use this financial tool. It's a process. You got to be disciplined to do it, right? But it's not complicated. We're talking about an extra 10 minutes, maybe per quarter, that would take to do this. And yet, look what it can do with spending the same exact amount of money. Now, normally you pay your mortgage and you'll never see that money again, right? You traded it for the equity in the house. What if you could have the equity in the house and all the money that you put into the mortgage? This is a way to do that. Okay, so you would also have the potential of not only having that 1.2 million, but a tax advantaged 1.2 million. So in other words, you can access that money tax free potentially under current tax law if you use it correctly. And so we go into all of that. We could also set that up to where we could take income out of it at about $47,000 a year from age 66 to 101, right? That can supplement your retirement, your Social Security, and whatever you have in your retirement accounts. This is a great substitution for bonds. A lot of people look at it that way. A typical portfolio would change, to being more bond heavy in the later years toward getting closer to retirement and in retirement. Well, this is a great substitute for bonds, which haven't done great lately. And so let's look at a spreadsheet version of this real quick and see if this can help for those folks that like spreadsheets. I'm a big spreadsheet guy, so I hope you enjoy this. So anyway, this is broken down by quarterly. And I know it's a lot of numbers, but it's really basic, okay? So what you have is you've got the initial startup. In this case, we used $4,000 as kind of a jump starter lump sum. It's not money we're going to spend. We're just using it as a buffer. It's just like a buffer in your checking account, so you don't hit zero each month, right? You want to have a buffer of money in there so that when you have income coming in and bills going out, you don't hit zero. You always have a little bit of buffer in there. Same thing with this. We're going to do the same thing, right? So with the buffer plus your $6,000 you're already going to spend on that mortgage, that $2,000 a month mortgage, right, for a quarter, we're going to have a total of $7,000 liquid available. That's why these policies are very unique, because look at that liquidity first month, right? First quarter, we're setting this up actually within 15 days of setting the policy up. We're going to then take a policy loan because we have $7,000 available immediately in liquidity, which that's going to increase, and that $4,000 we put in there as a lump sum is going to grow. And we take out $6,000 as a policy loan. We then pay that policy loan back over 3 months at $2,000 a month, just like we normally pay our mortgage. Right? There's 6 in, 6 out, right? We've got a total cost of $6,000 because we paid our policy loan back. And what's our balance at the end of that first quarter? $7,000. Our death benefit, which by the way, we got a death benefit on this by just paying the same dollars we were already paying, is $396,000. That's going to grow every single year because of the way these policies are designed. It's not like a typical life insurance policy when you pay for a flat $500,000. In death benefit, and that's what it is until you pass or the term expires if it's a term policy. So if you do this for 4 quarters, 1 year, at the end of that year, you're going to see this money grow, right? And along the way, for instance, let's say in the second quarter, for instance, you decide, you know what, I've got plenty in there to do my mortgage concept. I want to go ahead and pay for this vacation that we were talking about. And it's $3,000. Do you have enough money in there to do that? You do, right? And you could easily do that. You just got to pay yourself back and make sure that you funnel that money back in. So set yourself up on a payment plan. Okay, $3,000 for the vacation. I go on vacation, take a policy loan, goes right into my bank account within typically 3 to 5 days. It could sometimes take up to 7 business days. The money's in my account. I go ahead, enjoy the vacation, and when I get back, just like I'm paying back a credit card, what would I do? I'd say, okay, I'm going to pay $300 a month. $200 a month, whatever it is. I have the flexibility. The payback schedule is completely up to me. That's the other thing that makes this very unique. What if you have a tight time for a few months? You need to take a break on those payments. You can do that. You're in control. You set the payment terms for the repayment. Okay. Technically, you don't have to repay it. It actually can come out of the death benefit when you pass. But we don't recommend that because we need to refill the pipe for future spending and future investing, right? And so at this point in the third quarter, we got about 13,800 liquid. So you can see throughout this time, we're not just using this for the mortgage. We can use this for a lot of things, maybe a used car for the kids, whatever. By the first year, we now have added another benefit to this, the dividend. So the potential dividend or projected dividend for this policy is about $2,100 by the end of the first year. And so we have $2,100 adding to our system. Plus, we're going to have whatever guaranteed growth, which we get every day guaranteed growth, plus some increase in liquidity for a total of the guaranteed growth and increase in liquidity of about $3,400. Now, we did have some interest costs. Remember, I told you it's a policy loan, so you pay a little bit of interest on that simple annual interest over that 90 days. And so it's about $864. Well, your dividend's much larger than your interest paid and your guaranteed growth plus your increase in liquidity. So you have a positive arbitrage, right? And so now you did this, you paid the same exact amount of money for your mortgage as you normally would, except now you have by the end of the year $21,485 just by changing that one step in the process. Your death benefit's now $441,000. So by the second year, you've got a dividend projected after another 4 quarters of doing this in the second year of $2,800, and it just keeps on going up. Now you have a pretty big jump in that second year because of the liquidity increases extra on that second year, just the way the policy is designed. But then from that point on, it starts to be more consistent, increasing each year. And as you can see, at the end of 5 years, all you did was pay your mortgage, right? And you got $113,000 sitting in your policy, able to be used. So if I said in year 3, do I want to purchase a vehicle and still be able to do my mortgage concept? Absolutely. I could take a policy loan for 40 grand and go ahead and pay for a vehicle. And now I go down to the dealership, pay cash, negotiate that deal, and then I pay my policy loan back, the car payment I would have paid to Toyota, and I recapture that interest, right? Now I'll pay some interest to the insurance company, right? But I'm going to be paying a whole lot less, and I'm going to be growing that money the entire time. So if I took 40 grand out of this in the end of the third year, for instance, that 40 grand is still growing in my policy because remember, I took a policy loan. I did not remove the money from there. That's the beauty of this system. My money's growing even while I use it. So all I did was pay my mortgage. That's it. I just paid my mortgage. I did it a little bit different. I changed a step in the process, and this is what it ended up. And you can see in year 10, we're looking at $260,000. Can you imagine of paying your mortgage for 10 years and this is what your savings looks like, right? And this isn't including all the other ways that you might be saving in your 401k or your Roth or whatever else you might have, right? End of 20 years, $667,000. End of 30 years, you've got 1.2 million projected, right? And this is very conservative projections based on a low interest rate environment. And you've got 1.9 million in death benefit, right? And it just keeps on growing from there. It's a permanent policy. It lives as long as you do if you keep on paying the premium like you're supposed to. And the premium actually can be stopped on this at any time in the process, usually after the 5th to 7th year, which we don't recommend. I can show you why that is. You want to keep putting premium in this. If you went to the bank and put in $10,000 and they gave you an increased balance of $15,000, how many times would you go to the bank with $10,000? Well, of course, as much as you can, right? So I walk you through all that process. But this liquidity is all yours. So let's say in the end of the 10th year, you actually said, you know what, I'd love to invest some of this money in a piece of real estate and have a rental property. Well, great. You could take a piece of this, say 100 grand, put it into a rental property. Now you've got income from the rental property and you've got the policy growing, and that money that's in the rental property is growing in the policy also. So you're getting a return in both places, which is very unique in this vehicle. You can't do that with a lot of things, not with this flexibility, and especially this ability to control your money and repayment schedule and all of those things. And so those are some of the characteristics which really make this valuable. As I said before, we have a death benefit, right? Now, with a death benefit, we also, with most of these carriers, have living benefits. So let's say, for instance, someone is in their 60s or 70s and they end up having to have bypass surgery, heaven forbid. There's a way to actually take an advance tax-free of their death benefit to help pay for loss of wages, to help cover the cost of medical procedures or things that aren't covered by insurance, to help with whatever. You use it how you want. It's up to you. Same thing with needs and chronic needs such as Alzheimer's or something like that, right? Where you have to have a care facility or maybe have a person that comes into your house and helps you with that. you can have a tax-free advance of your death benefit. Let's say you need 500,000. Well, you got in 30 years, you got 1.9 million. You can take a tax-free advance on that and be able to actually use that for your needs, and no one's going to tell you what you can use it for. You could say, I want to go to Disneyland because life is short. That's up to you. You have that choice. And so it adds flexibility. If you need to be in a facility, a care home facility, wouldn't it be nice to have access to this money for that purpose rather than having to sell off your assets for the purpose of a Medicare facility that you may not want to be in? And so you got options. That's the point. And so I go into more details on this on the individual basis, and I'd love to do that and walk you through the numbers if you have questions on it. But this is what I'm going to cover for today. So I hope this was helpful and of use. And if you have any questions, please comment, reach out in some way, set up an appointment with me, and we can go over the specifics. Have a great rest of your day.